Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I am Andy.
I'm Brian.
And I'm Will.
Today, we are going to break down 4 industry articles. Guys, we are first talking about shoppers. Shoppers are gearing up for the spring home buying season. This is from Zillow, but via Housing Wire. We have from surging layoffs to a presidential election, what will 2024 bring for the housing market? Coming from Realtor.com. Homeowners are staying in place twice as long as they did 20 years ago. That's from Redfin, again, via Housing Wire. I'm not sure if I'm surprised by that or it's just like verification of a bunch of other stuff going on.
Yep.
So a little data behind that one and some chatter and a couple questions for you guys. And then new student loan repayment plan could make it easier for borrowers to become homeowners. So I got a couple questions about this, some rules that are changing, some that might still change. That's from CNBC. So we're going to go right from the top like we normally do, guys. Shoppers are gearing up for the spring home buying season. Coming in from Zillow, well-priced homes are selling fast, often within 29 days, and that time frame is bound to shorten as the shopping season opens.
Yay,
Agree? Disagree?
Yay.
Or do you think?
Where?
Not somewhere else. Somewhere else.
Now, you know, in California, San Diego, obviously, it is just... you put a house on the market, it's going.
It's gone, yeah.
So it's just like we're a machine, it seems like right now. But I know other parts of the country are not having the same experience. Day in, day out, this is San Diego. People are still like, they feel like they were on the fence. And now it's like that fear of missing out. I got to go after it, you know. So I think they are preparing.
And inventory being light is part of that as well. Like, to your point, right? The lack of inventory, I think, again, pricing with, I hate to say affordability, it's just the term. I'm not saying things are affordable necessarily. It's just that affordability kind of got a little bit easier here at the end of 2023, beginning of 2024. And so I know locally this is probably not likely to hang around much longer. I mean, it's going to be shorter than 29 days.
Yeah.
It's way shorter. But, the interesting thing is that's the average. Like, that means there's places that are still on the market way longer than that in other parts of the country. So there's something to be said about that. I think there's a little bit of an attitude shift and some awareness. This is the article cites to lure more buyers. Sellers are coming to terms with the market conditions and are agreeing to apply price cuts to their homes. And we talked about this in other shows where, a normal price cut range is 30 to 35% of listings. In 2023, 36.4% of listings had price cuts. And again, price cut could be $10, but the idea here that sellers are coming to terms with the market, meaning that buyers who are also coming to terms with the market are starting to have some consensus. And I think that's what we're seeing.
Yeah, absolutely.
And to follow up on a little bit of a more positive note, it says right here there are slightly more homes for sale this year than this time last year. And there's still plenty of competition for well-priced homes like you mentioned. But one of the things it does follow up to say is that buyers should prep their credit scores and sellers should prep their properties now. Attractive listings are going pending in less than a month. And the time on the market will shrink in weeks ahead. And one of the things I like about that is that, the market's going to start heating up in these months to come. And I feel right now it's a good opportunity to start preparing. And even for the people that are going to, down the line sell their house this year, it's time to start doing the spring cleanup sooner rather than later.
Yeah. The Zillow report is saying that in January, 1 of 5 houses listed on Zillow included a price cut. Now, 1 out of 5 is 20%. That's way below what the normal range of 30 to 35 is. So, when people are talking about prices needing to plummet and all that, like this doesn't help that argument. This runs counter to that. I know this is just one sample set 'cause we're talking about Zillow here, but like I said, the normal range is 30 to 35% of homes on the market will experience a price cut of some sort, and last year it was 36.4. The projection this year is 32%.
Price cuts?
Yeah, 32% of listings will have price cuts in 2024 based on some, other factors we talked about in another previous show. But
it is the beginning of the year, guys.
Yeah.
It's as exciting as it sounds, it's still the beginning of the year.
But spring is the time that everyone does this, though. Like the whole spring, we talk about this off camera. It's like March is when everything starts picking up a little more, and the momentum happens, and we see more inventory, more activity, more applications, more approvals, more escrows. It's like this is why, though. It's all preceded by all this kind of stuff.
Yeah. I think for the sellers that listed before the year ended last year that the house is still on the market, they probably have a bigger incentive for them to lower that price point because of the fact that they need to sell, or they're just like impatiently like, I need to get rid of this. Yeah. While buyers are probably holding the line to see how much more inventory comes out, how the market plays out in the first quarter, and then start making their decisions.
Yeah, and let's remember, the one that really determines what the market's doing are buyers.
Yeah.
They're the ones that are going to pay the price. They're the ones that are willing to I would like that property for that price.
So that's what I was going to ask. Like, aren't they doing it to their own detriment, though? I mean, if they're saying, "Oh, I'm just going to wait and see if there's more inventory," or like, isn't waiting costing them? Not just, I don't mean money, but isn't it costing them the opportunity of either getting a house or not?
It is, but it's funny
Because you're blind. Sorry, I'm saying you're blindly
Yeah.
waiting. I don't know the people around the corner that are going to sell their houses. I don't know the reason they're going to list and when they're going to do it. So I'm like blindly thinking, oh, there's just going to be a better option for me next month, when I have no idea if that's true or not.
But that's the case a lot of the times that people don't know. So they're just like, hey, I'll just wait. But in reality, they're not prepping themselves to actually, take that leap into the market when the opportunity does come. So I feel it's still them, not knowing what they don't know. So it's like, I'm going to wait. Houses are too expensive. That's all they hear on the headlines. So a lot of it comes to their behavior and how they, want to either buy or not buy.
A lot of times they're just not finding that right property just yet.
Right.
Sometimes they're just being a little picky and saying, hey, this is going to be my forever home. It's going to cost me a pretty penny now. So certain houses aren't working out. I'm just going to continue shopping and waiting. And so they become to be in that category, or maybe even consider to be on the fence when they're really not.
Yeah.
Well, and I hear that difference. I hear the difference between just I'm like stubbornly waiting. Like, oh, I just think there's going to be more later versus I'm actually trying. I'm just not finding the thing I want.
Because again, the limited supply of homes. So do I just go into it and, okay, this is it? Move on? Or do I take my time and find that proper home? So there's a little bit kind of,
And I see how that would play in part because of the fact that it's like, you know what, it's not there. It wasn't for me. Let me just go keep renting.
Then there's that.
So they just completely stop.
Give up.
Yeah.
There's that.
And recently I've been speaking to a lot of clients that feel that they're not ready, but once you go through their income and their finances and you really determine what they're paying, they can afford it, but they don't want to.
Yeah.
And that's something that I've been, finding as an obstacle where it's like, I make $10,000 a month, but at the same time, I don't want to pay $4,000, $5,000 in rent, in a mortgage.
So are you saying, okay, so I understand you saying there's a willingness, but you were started by saying like they didn't think they were going to be able to qualify too?
Yeah. So I spoke to
So part of it is that they didn't know, and then they came to know, and then once they knew, they're like, I'm not sure I want to do this.
Yeah.
Because I'm like, and then speaking about in certain areas that they're talking about, like, I want to buy a house here, I want to buy a house here, and I'm like, well, that already puts you a little bit further from your budget that we talked about, knowing those areas are high price and high level, like people wanting to move in there.
High demand.
Yeah, high demand. There it is. Yeah.
High demand and high price, high competition, and wow. Okay. So part of it is they did not think they could qualify, found out they could, and then once they found they could, they were like, I don't want to do
payments.
Yeah, wait a minute, I got 45, but I'm paying 2,500. That's like $2,000 more.
Yeah, no.
And those things happen. Like it's a big reality check, right? Because again, these other things that we don't know, when we qualify people, we're qualifying based on their gross income. We don't know if they're tying 10% to their church or they're giving to a nonprofit. We don't know all these things. We just kind of take it like, and we also don't consider the fact that their tax bracket, right?
True. That's true.
It's crazy that you bring that up because that is so true. Like for us, when we see it, it's like, gross income, good, you got it. But then you tell it to them, well, wait a minute, I get the paycheck after it doesn't look that nice. So in my budget, it really doesn't make sense.
Yeah.
But I like that people are starting to take that leap of faith and wanting to know what that looks like because obviously the renting side isn't giving them, that reward or that fulfillment that they want at the same time. So it's like, you got to pick a lesser of two evils at the end of the day. But the long-term commitment is better one route than the other.
And you talk about fulfillment.
Yeah.
Owning your home and being in your own home, knowing that's yours, you take a sense of pride and it fulfills you in certain ways, right? Because this is mine. And so, I like that you use that word. So,
well, I mean, even in the last show we were talking about, the article is homeownership the new humble brag, and it's like there's a split decision about whether it's a braggy thing or if it's something to be celebrated and accomplished as a milestone.
Well, I just feel like, you got a house in this market?
Yeah.
Hey, what are you, rich?
What's your rate?
Yeah. But again, the good thing about all of this is we're giving this information so that people could just take it in, see how you're going to process it, and then how you're going to take that leap of faith of moving forward, so it gives you that education.
Well, good news from this, guys. There's reason for shoppers to be gearing up for the spring home buying season because inventory is up. So total inventory up year over year from January of 23 to January 24. Inventory is up 4%. Or sorry, 3%.
3%.
But look, okay, I understand. Let's qualify this. 2023 was a crap garbage year for inventory. So it being up 3%, like, wow, 3%, that's amazing.
Yeah.
Like, okay, well, it came up 3% from the bottom of the basement. Now it's like peeking its head to the first floor, like, hey, anybody home?
Yeah.
Hey, I'll take this for one of our past guests on Friends of Mortgage Heroes. Buyers weren't buying and sellers weren't selling.
Yeah, that's right.
It was one of those crazy years.
Noted in this same thing is San Diego. Sellers are still holding a strong position in markets like San Diego, Miami, and Riverside, where new listings are up by a respective 28%, 22%, and 20%.
Dang.
So while I'm a couple minutes ago telling you about inventory up 3% year over year, San Diego's up 28%.
Wow.
So that means two things. Number one, a lot more inventory now compared to last year. Duh, the number says that. But that means it was really bad last year because we're not even at normal we're not even close to normal inventory. So for me, what this sheds light on in the rearview mirror is, wow, 2023 inventory was terrible in San Diego, and now it's not even still back to normal.
Again, this is the beginning of the year, guys. Something is better than nothing. Right?
Of course.
And it's going to take years before we see any type of normalcy.
Right.
You know, in the home inventory sector.
Well, but I guess you're kind of making my point in other words. It's like this is a January to January reading. So January to January, San Diego's up 28%.
Yeah.
If that carries throughout the rest of the year, then what should we expect for our buyers? More inventory. So to your point about people either not willing to or still wanting to have that American dream in San Diego, like there should be some hope that there's inventory coming because even January versus January, if that's 20% different, what will it mean for the spring and summer season when we actually see more people come off the sidelines?
I am praying to the inventory gods that we have more homes, okay? And I mean, like I said, beginning of the year, I know there's a lot coming up, like elections and all that good stuff. So a lot of things can change.
Oh, yeah.
People can retract. Sellers can retract, or they can, just go out there and say, I'm going to sell.
Yeah, no, I think this is good. I mean, I'm in general, I'm optimistic about this. Not just because Zillow's going to put out some. Of course, Zillow's going to want to have a good report about people gearing up for. Yeah, of course, everyone in real estate wants that. So that's already a given. But when the data backs it up, and you're like, oh, inventory at large is up nationwide, including places where it's terrible down in the. I mean, look, if San Diego's up 28%. Someone else is down 28%. So we're not in the drink. Someone else is having a massive inventory problem that we aren't, or we are getting out of, I should say.
That's it.
So,
yep.
All right, guys. Next, we have from surging layoffs to a presidential election. What will 2024 bring for the housing market? I feel like this is an article that should have come out in December 23, but it didn't. Came out in February.
Even better,
24.
we got it a month into the
we're getting it a month and a half into the new year. But even though the year has just barely begun, we have four major things that this article is citing. Presidential election, two large wars abroad, high-profile companies announcing layoffs, and fears over whether or not the Federal Reserve will be able to guide the economy to a soft landing. Haven't we been talking about that for like 2 years now? Soft landing. Transitory. Hey, remember that word, transitory?
Yeah.
So let's just kind of go in order here, guys. So the first thing is I want to quote this quote that came from a senior economist at KPMG who said, in 2024, the only thing that is certain is uncertainty itself. And uncertainty slows the economy. And these things do not play out quickly. Yeah. So the first one is the presidential election, okay? There are a lot of divided people about what they think should happen and who should be the one to make those things happen. No, this is a very uncertain part of the show and of our timeline here. But it says the anxiety that the presidential election brings can cause some would-be buyers and sellers to hit the pause button, regardless of which party ticket they prefer. Explain this to me, because look, I understand politics is important, and it has a varying degree of importance to people depending on who you talk to and what they're fighting for.
Oh yeah,
but I don't understand, and I cannot relate to it deciding for me whether or not I buy a house in 2024 or not. Explain that to me.
I feel that it's people's personal problem, that it's their decision. Like, hey, I believe that I think they could do better, or I believe that I think this happening is gonna, cause something in the market. When in reality, I feel you should be keeping a close eye on the data, because there is going to be strategic times where you can make a good move, that you can, take a good deal, get a low rate. But throughout the year, if they're telling you uncertainty, then be ready, because there is going to be times where you can, progress, make a move. But I just don't see the presidential election being nothing but a big headline that distracts people from what really is the catalyst.
That's a great point. I mean, it is what it is. Whether there's blue or there's red, right?
People are still buying houses.
You're gonna have to buy. I've owned a home when there was a Democratic there, a Republican there. Yeah. Nothing's changed. The only things that change is the economy, right? But even they don't have the exact, remote control to control everything. They can't.
Well, everyone wants to like push off blame and responsibility when it's bad, and everyone wants to take on accolades when it's good, regardless of which side you're talking about. But and again, I'm not getting into this versus that conversation with you guys or anyone in the comments. I'm saying that explain to me why someone would or would not make their house decision, because again, when we talk about uncertainty and we talk about jobs and your employment, like if you can qualify now, why would you wait if you're like, oh, I'm gonna see who the president's gonna be? I mean, unless that directly impacts your actual job or your income in a like A to B fashion, I don't understand.
I mean, the only thing that comes to mind is usually when there's a new election coming up and no president wants high gas prices, no president wants high inflation. They don't want high interest rates. So people are looking at it like, well, the new one's coming in, so let me just wait until we get closer to that. Maybe rates will get lower, and maybe now I can qualify for that bigger home that I'm really looking for. Or instead of qualifying just for $400 right now because rates are so much lower, I can qualify for $500,000.
Right, like purely strategic.
Trying, exactly, but we never know, right? We never know what can happen, but we could just assume that these things may happen based on previous years of when elections happen. That's what more or less was the norm.
That's a good point. I think it's, their behaviors. If like what they experience in certain terms, if they bought houses before, maybe that's what they're taking as a guide. Like, hey, like, let me see. Maybe this president is going to put in policies that is going to stimulate something in the economy that, I don't know, maybe, fixes home prices.
Well, and some of it just historically is someone inheriting what had happened in administrations prior or several administrations prior. I mean, look, we got in the industry in 2005, and at the time George Bush was the president. And 2001 had happened, and September 11th, and the whole thing. And then there was this whole like get a home, and like the market unleashed all these products that maybe in retrospect it shouldn't have, and it ended up causing the great financial collapse that happened in Obama's term. So it's like that carried over. And again, I'm not blaming. I'm just saying historically, Obama became president, and then he had to take over what he inherited from the previous administration.
He inherited the mortgage meltdown.
Well, right. And then he was also still president until 2016, and the recovery had started in the early teens of the 2000 teens. And then you have Trump, who comes in after 16, and then you have rates go, and then you have rates go down during his administration right at the very end. And then you have Biden, and now we have all this. So it's like, there's this overlapping nature to this where to me, I look at that as like and I go, well, I can't let that determine or dictate what I do or don't do because of all of those previous things happening, regardless of who's standing watch.
Yeah.
I guess that's my point.
Yeah, well, hey, you remember Obama had that incentive, $9,000, I think it was, if you bought a home.
Yeah, the home buyer, first-time home buyer credit or something like
Maybe
that.
Maybe we're waiting for that. Let's see what this new president does.
And I think that, and remember that was like when home prices were at like the glut, the very bottom of home prices. The whole thing had fallen apart. People were nervous, didn't want to buy homes, didn't trust banks, didn't have. I mean, that was nasty.
Yeah, we had plenty of inventory. It was
too much inventory.
Yeah, 1.3 million homes available.
Ridiculous.
Higher than that probably is what it was.
So I think that people are going to be paying close attention. I guess what I'm admitting here publicly is that I just don't relate to people waiting for the outcome of the election to determine whether they buy or sell a house.
And I mean, right here it goes on to say, to back up what you said, usually home sales are unchanged compared to a non-election year, with the exception being November. By December, the market has usually returned to normal.
Yeah.
So you got that 1 month window.
You got that 1 month window, like, hey, let's see what happens.
Well, be prepared.
So for those who are waiting, November.
Yeah. Well, that's the lame duck session, right? So if the current president is voted out and the new one's not going to be installed until January, you got that lame duck session, lame duck real estate, which you call it. Hey, it's a new show, new playlist. All our shows from November to January will be the lame duck series.
Which comes to the next one, right? Could the presidential election stall home sales?
Yeah, I don't know. I mean,
me neither.
Again, this is a personal decision people are making, and I guess it does come down to whether or not they think it's that important that they should wait or just do it now. I think just too much of that is wrapped up in individual choice, of course.
Again, let's ask the audience, hey, in your comments, please.
Well,
let us know what you think.
That is a good question. Like, who would wait to buy or sell because of the outcome? I understand there's a lot of reasons why someone would say this or someone would say that based on where you sit in the economy, where you sit with your leadership, where you sit in your specific industry, and what might be second and third order effects of who the president is. But yeah, that'd be interesting to learn and see what you guys say about whether you would or wouldn't be doing certain moves in real estate because of who the leader is.
I mean, if I qualify right now, I'm able to afford something. I just can't find something. I like to just be prepared, right?
Yeah.
Let's see if opportunity comes, but at the same time, like, I'm cautiously waiting.
Cautiously cautious.
Cautiously.
Yeah, you know, just cautiously being cautious, you know, like, hey, do I really want to buy in this high interest rate? Maybe I can wait.
Yeah.
Do I really have to pull the trigger now?
Yeah.
So, you know, it just, again, it depends on that certain situation that a person's going through.
So the next thing here, guys, they're talking about unemployment could hurt the housing market.
Yes.
And, you know, we've kind of talked about this from the beginning, from the start when the Fed started raising rates. You know, I put my nerd hat and I'm like, this is going to hurt corporations because those who are carrying debt connected to prime somehow. That's going to get more and more expensive, and they're going to have to remove expense from somewhere else on their budget and their line item of the profit and losses, and that means employees. So you have the threat of widespread employment, and the news has recently been filled with companies with household names such as Google, Amazon, UPS announcing layoffs this year. Last week, Toast, some of you guys know Toast, the payment processor, they announced they're doing a 10% layoff, and then Nike just announced that they're laying off like 1,500 people or something like that.
Yeah.
So there's even more household names. And, you know, I don't know how much of this is us peering into the future of what could be bigger problems, but I get this because it's actual job loss. We have unemployment that is still at 3.7% in January, which is, you know, according to federal unemployment data, which is still really good. I know we've talked before that historically a 3% turnover rate is normal, is considered fully employed because there's always 3% of the population that's either hiring, firing, or transitioning to a different career or job. And so 3.7 is pretty healthy when you look at it, as long as there's not a lot of stuff, you know, not a lot of cooking in the books. But we've been talking about this, guys.
Yeah, no, it's just crazy that Amazon's one of those, right?
Well,
when they reported their highest profits this last quarter.
Right.
It's amazing. But here's the thing, guys, too. The other thing that they're not mentioning here is they're determining layoffs. We don't really know for what reason. Right?
That's true.
I mean, there's AI now that's been kind of taking over. You guys, Terminator's not coming out anytime soon, okay? But they're also, you know, looking and investing into AI. They're probably taking those jobs that people aren't really required to actually replace them with this AI tool. So maybe that 10% could be or 5% could be. We really don't know because they're not going to tell you exactly what the reason is.
Yeah, and I think that's why I'm not sure if I agree or disagree with this whole unemployment being a problem thing, because I think obviously it's a problem for the individual, but I don't, not all jobs can just be eliminated and replaced with AI. They're not going to come and unclog the toilet, replace the pipe that goes from the main of the city to your house. Like, that still takes labor. That still takes work. Someone's going to still change my oil in my car and fix the tire on the side of the road, that kind of thing. So,
but that's why it's only 10%.
Well, so you know, the article is saying that while things are far from perfect, the economy is probably doing better than people want to give it credit for. Do we agree with that or not?
Oh man,
do we agree?
I think it's
disagree.
There's no middle. I think if you're doing good, you're doing good. If you're struggling, you're feeling the pinch. So I don't think there's like a middle, like, hey, we're like doing all right, we're getting by. I think it's on a two.
Just like with us, it depends what area you're in. You know, with real estate, it also depends what career you're in. I mean, the fact is, for lenders and for realtors, yes, we're all hurting. There used to be a buyer's market. There used to be a seller's market. 2023, there was none.
There was no market.
Yeah,
you know, it was like almost no market. So it just really depends on your industry. If people are looking to improve their business and they're getting into it, well, then you have these tech companies out there that build the software around you so that you can manage your business better. I don't think those people are hurting.
Yeah.
So
you know, I really think it's what industry you're in.
No, 100%. And also, I feel like the people working, right? Depending on their age, how long they've been at the company, I feel a lot of people are at different points of their life. If you're a young worker starting your life off with a new career, you can get fired and pick up a new job. But now, if you're kind of already older, been working
thanks,
for a long
Brian. Why are you looking at me?
I'm not.
He's like, I have nowhere to look.
So if if they're older and they get laid off, it's going to be harder for them.
Absolutely.
It's going to be harder for them to go back into the workforce when they've been doing something for so long that they're accustomed to, and then now saying, "Hey, you're done." They have bills, they have families, they have a mortgage.
And I got Walmart.
I have a.
But
friend,
is Walmart going to be able to pay for you?
I'm a good greeter.
I have a friend who is looking for work in a very specific industry that he has more than 20 years of experience in, and he's overqualified. And they will not pick him up because that industry is in contraction. At the same time, he is at his peak of ability inside it. And so there's too many people looking for the same job, and that job is changing because of technology. So it's not that he misunderstands technology. He actually is really good at it, but there aren't enough open desks for the people with his level of talent.
No, it's true. Again, it just
overqualified.
Depends. You can never overqualify to greet people.
Not to greet, say hi.
Yeah. Hey.
Oh no, we do very good at it.
Hey, hello.
Yeah. Shout out.
How you doing?
Shout out Charlie at Eastlake.
Oh,
fired
¿cómo
up.
estás?
Fired up, guy.
Yeah.
How you doing?
Yeah,
Fired
¿cómo
up.
estás? Oh, yeah, you're looking for tomatoes or tomatoes?
Somewhere over there.
Potatoes, sir.
Papas.
Those who are concerned about stability of their jobs are a lot less likely to go home shopping. That just reeks of sentiment.
Yeah.
And job security is something that impacts consumer confidence. So it's why we look at consumer confidence reading, and we talk about on Monday Mortgage Minute, we talk about sentiment, and we take some opinion, and we talk, hey guys, do we agree or disagree with that? I think, again, all that is to say that uncertainty is really a big problem. Unemployment is part of that. Let's move really quickly over to the wars abroad and how that might affect the U.S. housing market. So
Not a problem.
I don't see that it's a big problem on one hand, and then I do see how it's a problem on another, and it has a lot to do with inflation and goods and services. So if we have issues with the supply of, let's say, oil and other like raw material goods that are coming from overseas, and if shipping routes are blocked or they're unsafe or things like that, then our prices are going to go up. That's going to make inflation worse. That's going to hurt debt to income. That's going to hurt affordability. So I guess it's a possible big deal, and we already right now have higher CPI and PPI data in February. They were the January readings that came out in February. They were higher than what we were expecting. So we're already fighting the inflation issue without this thing being in a full-blown catastrophe.
Correct. And here goes our money again, taxpayers' money.
Go ahead, say it. Say the whole thing you want to say. Taxpayer money out the window?
Yeah,
Back
here it goes.
Okay.
everywhere but the border.
Here it goes. And
There it is. I had to say it.
here it is. When I
Let's
really
go.
feel...
Let's go.
This show's going to
Let's
get
go.
like just so much...
Sorry.
We need
Sorry.
that. Comments.
I'm just...
Let's go.
No. I'm just like... Don't we have enough issues here that we
Yes.
can
Thank
utilize
you.
some of these funds?
Let's go.
To, like
Yes.
downtown San Diego, I mean, we're fighting with a lot of homeless people here.
But no, we're
Well,
hoping.
that, and we're down south, and we're a little bit east of the coastline here where we're
Yeah.
located, and we have friends out a little east of us, and we have friends that are on Border Patrol and the
Yeah.
sheriff out there in East County, and they are encountering all sorts of stuff going on. Now,
All sorts of stuff.
I understand that, this part of the article is talking about kind of like the war abroad stuff, but we actually have stuff happening in our literal own backyard at the same time. That I don't think necessarily directly changes real estate decisions for people here, but I will tell you what, if they have an affordability issue and you can't put food on the table, and we're certainly not talking about you buying a house. If you are trying to just make ends meet and put food on the table and put gas in your car and get to work safely get to work safely and get back to work and back safely. God,
I like it.
I'm gonna go take some speaking lessons.
Me too. Take me with you.
So, I don't think that the Fed stepping in is going to help that at all. I mean, you're talking about like global international politics that is weighing in on what could locally be happening here. I'll say on the local national side when it comes to what we do or don't do.
But all these things will affect us. They will affect buyers. They will affect sellers. You're talking about, two big major wars out there. We have the beauty of the U.S. We have a lot of these families here, and they're watching the news. They're seeing these things, and they may not want to make any moves.
Yeah, I think,
I don't blame them.
I think the two things cited in the article in this section about the cost of goods and cost of gasoline rising, it's an inflation conversation. It's an inflation problem. And again, like to Brian's point a minute ago, it's like if you're making it, you're really making it. And if you're not making it, you're really not making it. And that's hard. It's very unique to have an in-between. You're like, I'm kind of making it, and I'm kind of not. But I don't know that the Fed cutting rates is going to be a good sign. And again, with this inflation data right now, I don't even know if they can. I honestly don't. And we just recorded a show 2 weeks ago making
you guys,
Like there's so much
about when they're going to cut.
There's going to be 6 cuts.
So there's so much.
I
I just feel there's so much interconnectedness with the with the economy, with this and that if if you do one thing over here, it messes up something over there. But then if you don't do that, then you can't get this over here, and it's just where'd I go? What'd I do?
The whack-a-mole.
You're like,
you knock one down, no one pops up.
Yeah.
That's literally what we're doing.
So are you guys still sticking that they're gonna cut rates 8 times?
No, not 8 times. First of all, I did not agree that it was 6.
That's what I was going to say. I agree to some, but I don't know about 8.
I said 3 to 4.
Run it
and
back.
I said their first one would be in April. This week, I definitely think it's not going to be April. It cannot be in April. There's no way.
Well, some were saying like, it was going to be right around the next Fed meeting.
No,
that ain't going to happen.
There's no way. Now they're playing with fire. Now they're backed in the corner even more because they can't even say that the data's on. And what have they been saying for like the last 8 months? Oh, we're going to look at the data. Look at the data. When they started doing pausing, remember they said we're going to pause and let the data decide what we do. Okay, now the data's coming out, and the data's saying, hey, inflation didn't go away.
The data is not dataing.
Cannot compute. 404 error page not found.
Run it back.
Editing,
happen, guys.
insert fax noise right here. Yeah, I think that's going to be the problem, guys. The wars are the wars. I'm not trying to be glib about it and be like they're not important, but I'm just saying like there is a problem with the conflicts we have ourselves involved in, the money going where it's going, and in the amounts that it's going to, and for the reasons when it could also be going other places.
The major thing is for the reasons.
And the Fed stuff. I mean, the Fed really is going to be playing. They're going to be probably the biggest player this year for all the financial markets for sure. I think the election is honestly number 2.
Yeah.
I think the election would have been number 1 if it were not for this last month's report on inflation. Now it's the Fed. It's the Fed. It doesn't even, not the election doesn't matter. It's going to be the Fed number 1, and number 2 is going to be the election, in my opinion.
The Fed will matter in November. I mean, the election will matter in November.
In November, yeah. Right now, it's the Fed fighting. They're running uphill against the wind and peeing themselves.
Holding on for
What a touchy subject, to be honest.
Yeah.
Moving on.
Next article, guys. Homeowners are staying in place twice as long as they did 20 years ago. Surprise, not surprise.
Hello, surprised.
Coming in from Redfin, the report derived from census data shows that today's homeowners are staying in place for a median time of nearly 12 years. So all homeowners above and below 12 years is the median time that people are staying in their home.
I believe
That's
that.
crazy.
I believe that. I do believe that. And I'm going to tell you why. When I was younger, I was a little more, I felt more resilient and wanting to take more risk. So I remember, hey, I was in this house. I think I need a bigger house. And then we ended up getting a bigger house. And it was like almost every 2 years. Mm-hmm. This last home, we purchased it back in, towards the end of 2012. And I've been in there. And it's like, do I need, now I'm understanding a need versus a want. And so now I kind of contemplate, do I really need that? I want a lot of good things. Trust me, I like it. But do I really need that? Do I really need it? And so I think it's going to keep me in place here in my current home for a long time. Why?
Yeah.
I got a very nice, comfortable payment, and I have a home large enough.
Yeah.
I was able to do an ADU, bring my in-laws in there. And now to actually find that home that actually can cater to both families, I think it's a little more difficult to do.
Yeah, that it is.
And the cost.
I think, and you're at the you're at the 10-year mark now at that house, right?
Actually, no. Well,
I thought
2012.
You're at the.
Oh, okay. I thought I had the year wrong.
Passed,
Sorry.
yeah,
You're right
it.
at the 12-year mark.
There you go.
Oh my gosh.
Well, do you need to
so
move?
that's still longer.
Hey,
are you moving soon?
Yeah.
His new show nickname is gonna be Median Memo. Median Memo.
So I could agree with this.
Okay.
I think more people are doing it. They're seeing it more or less like this is a longer term thing.
And my argument was going to be the cost of prices going up on houses. Obviously, before they were a little cheaper, maybe your compensation made for you to be able to jump around. But now, as we know, and we've been following the data, incomes haven't gone up enough for them to support house prices. So that's probably a huge factor as well.
Yeah. And, this article is citing that the length of time homeowners are remaining in their properties doubled to 11.9 or 12%, or 12 last year, up for 12 years, up from 6.5, which was in 2005.
Wow.
So just shy of 20 years ago, it's flipped double almost in that amount of time.
It's ridiculous.
And we used to say not everyone, broadly, most people would refinance every 5 to 7 years.
Yeah.
I think that's now going to change next. So I think another order of effect is that 2020 and 2021 and early 2022, all those refinancing half the planet. I think that people are going to keep these loans for way longer than that. Because why are you going to get rid of 2.25 if there's like not even an inkling of chance that we're going to get under 3 again in the next year, 2, 3 years?
No, I mean I understand history repeats itself, but we're not seeing that anytime
well,
soon.
not
unless
in,
we
not
get
in
another
6 months.
black swan event type of COVID.
Here's what's crazy, guys. We listened to this podcast from Canada. You remember that, Brian?
Yes.
Yeah.
And I mean, when they're considered their 30-year fix is a 10-year.
Yeah, 10-year
and the
fix.
average homeowner refinances every 2.5 years.
Yes, and it was like 8% was like the average rate or something
Right
like that,
now,
right?
currently, 7.5 to 8%, depending where you go with the 3-year ARM, 5-year ARM.
Yeah.
ARM. This is an adjustable rate mortgage, not a fixed mortgage.
Yeah,
it's crazy.
Yeah, and so I think as a second order effect, you're going to see people refinancing less.
Yeah,
and then that's going to because again, if they are already let's say less than 4%, even let's just go to 4%. Yeah. If they have a first at 4% or lower, there is no incentive to refinance right now unless you are literally getting yourself in trouble or some life event is happening that is unplanned and unexpected, and you don't have a backup solution for. You lost your job, death, divorce. Whatever, dismemberment. Let's do other D words. Hey, how about I just said dismemberment?
Yeah, dismemberment, displacement.
Yeah, but so disability, death, divorce, debt, that kind of thing. again, but even then, you still have like a lot of equity in homes. There's a line of credit that's an option. I think refinancing is going to be really, really hard to come by.
Unless you're from 22, 23, you can't wait till the rates drop and you need to freaking, drop your rate because you got a 7 plus.
I do have a client that's actually PCSing to San Diego. They have an investment home. So we're refinancing them out of that VA.
Oh, okay.
Right? And the rent's going to cover it. So their current payment's $3,200.
Yeah.
Their rents are $3,800.
Yeah.
The payment, well, they do have not a 2 point something. They had like a 4.25% interest rate. So we're refinancing them to free up that VA.
Yeah.
The payment's going to be $3,800. It's going to go up that high, but they're okay with that because they don't have enough money to put down as a down payment.
Got it. And
I'm like,
VA.
do you guys have the 5%? No, we don't have that. Well, then let's do this. And they're like, perfect. The rent's still covered.
That's
the
purposeful.
payment, I'm sorry. Exactly.
That's purposeful because you're freeing up their entitlement. That's a whole different conversation. Yeah.
No, but you're stating unless certain life events are happening. And so I wanted to just illustrate a life event of this case to give kind of some people the idea.
That's really I'm glad you brought it up. It's a perfect example. I don't mean to argue the point. I'm saying that like that is the kind of thing where it's conditional because of this other thing I'm trying to do.
Yeah.
Or in some cases it's a problem I'm trying to avoid, but in this case it's an opportunity I'm trying to unlock. So there is the opportunity unlocking part of this, which I'm glad you said that. I didn't know what was going on.
Yeah.
So that's a great example. And again, this is even a case of keeping that home.
Yeah.
So, this is people staying in their home, but this is someone keeping the home even though they're not staying in it. They're still keeping it and they're not selling it.
Yeah.
So that's them converting it from the primary into an investment property, which we've talked about generationally more people are doing. Also, people are getting wiser about how I leverage this debt over here to make this asset grow over here, let the market ride that property value up over the long course of time. And if they're PCSing, guess what? There's someone else PCSing in. Like, I get it. That makes a lot of sense when you put that out.
And what's funny about this situation too, was not funny, but this is the fourth conversation that I had with this family. They both have 2 kids. So like, what made you want to not sell that? Like, we need a kid for each of our kids. We need a house for each of the kids.
That's smart.
So that's what they're going to inherit. So these kids are going to be inheriting these properties in time. You know what I mean?
We talk about this when we talk about legacy. We talk about building a family trust and an estate plan, and like actually using real estate to leverage your family wealth over the course of time, and that transitional wealth from generation to generation. Like that this is the plan with people.
And we're just on the sidelines, I'm like that Mexican chant that they do. Sí se puede. Sí se puede. Like, yes, you can. Yes, you can. Yeah, we're getting it done.
So before we leave this article, guys, I was surprised, not surprised. 54% of baby boomers own their home free and clear without making monthly payments.
Except for the property tax.
Except for property tax
and homeowners
and insurance. But there's no mortgage. Like, that's crazy.
Yeah,
that's part of the equity conversation about there being so much equity, like compared to historically, highest equity on tap. And then also, that's a lot of people.
I can attest to that.
54%?
Like, listen, I can attest to that. I have a client right now. They're purchasing an investment home for their daughter. And their current home is free and clear, right? Free and clear. Fits in the baby boomers. Here's a crazy thing, though. We talked about they're paying property taxes. But in this case, I told you earlier, he is not paying homeowners insurance.
Oh, this is that story?
That's that story. Guys, so if you own your home free and clear, make sure you have homeowners insurance in there. He didn't understand why he needed to have that insurance in there. And I'm like, come on, protect your investment.
Hey,
in case of fire, in case there's an internal flood in there.
Oh, wait. Well,
internal flood, right? We already know if it's flood from out there, that's FEMA. Something else.
FEMA.
Right?
Wow,
but if you own your home outright and you're listening to this, go talk to your homeowner's insurance agent and get your home insured.
Yeah.
Okay? So wanted to share that.
Well, that was So the amount of baby boomers who are free and clear was again surprising, not surprising, because again what they were taught and what was expected is you work hard, you pay off your bills, you carry no debt, and you pay off your home, and then you live in your retirement years on whatever retirement you have. It's going to be enough because you don't have a house payment,
right.
You don't have personal debt, you buy your cars cash, like all that kind of stuff.
Yeah, that was the old blueprint. Now the new blueprint is different.
So I was gonna add to that. Like baby boomer starter home back then is a lot different than a starting home for a Gen Z and millennial. Like back then you actually got a house. Now you get a little shack.
Yeah.
You get a little apartment if you can get that.
Yeah.
So I think that makes it a lot different for millennials and Gen Zs. Having the opportunity, availability to be able to purchase a house because it's no inventory, it's more expensive.
Yeah, it's just making these younger guys a lot smarter. Social media.
Yeah.
They're understanding what good debt is.
So, and then it was funny because I saw that. Okay, so then the homeownership percentage of millennials and compared to Gen Z, compared to baby boomers and Generation X differs a lot. But I think it's because of the behaviors and the different motivations that we have growing up. They were looking at it different. Well, now it's like if I have a Gen Z millennial that has equity in their house, they're going to be like, how do I take this out and go somewhere else?
Well, I think
and keep this still.
That's the generation. That's the generation with the most wealth.
Well, part of it is conditions.
You know?
The conditions that set the table for them to have home ownership at large and broadly, with accessibility on a single income, which is mostly now not the case, where it takes two incomes and then a side hustle or something.
Two incomes, Andy? Are you being modest here?
I'm trying to be modest. Yeah. Okay. It takes
side hustles is
nine
kind of
incomes.
Like
3-4 applications.
It takes one income per day of week. 7 incomes to qualify.
Yeah.
So I think a part of it is the conditions that set the table for them to acquire home ownership, number one. Number two, I think the other is behavior.
Yeah.
I think it has a lot to do with just generational exposure and behavior
Absolutely.
to what are the
100%.
Cultural norms
Yeah.
that I was raised up with and I aligned and grabbed onto in my most, let's say, in my most influential years of making personal decisions about how I'm going to carry myself into adulthood and through adulthood.
No, absolutely.
So
absolutely.
there's a culture part and there's a condition part. So baby boomers, man.
booming.
Gen Xers.
What they say, like 40%. I think the article is like 40% have owned their house for 20 years or more.
Yeah.
That's all. I mean, you're talking all the way about 2004 now, pre-collapse.
Yeah.
And they still have.
And they still
that
kept
house.
it.
And they still kept it.
They huddled.
Yeah, hunker down. Dig your heels in.
Yeah.
Okay, guys. I don't know a lot about this next topic.
Same. I was going to say very interesting.
But we're going to talk about it because maybe some people watching can comment and share and give us some more insight on the personal front lines. I am not a part of this conversation, but I know we need to have this conversation. This is new student loan repayment plan could make it easier for borrowers to become homeowners. I think the article title is a little bit of a stretch because I think there's like 3 to 19 steps in between those two words, repayment plan and borrowers becoming homeowners. So a new, more affordable repayment plan for federal student loan borrowers may come with another advantage. It could make it easier to become a homeowner. It's like this 1-2 punch. That's not really a 1-2 punch. It's like step 1 is separated by 12 other steps before you get to the homeowner part. Yeah. So that's my kind of right out the gate statement. Half of student loan borrowers who haven't yet purchased a home say their education debt is delaying them from doing so, according to a 2021 report by the National Association of Realtors. In previous conversations we've had about affordability and about generational stuff, most of our comments in shorts and in the long-form videos are from millennials saying, I can't afford a house because of this or because of that or inflation or student loans, whatever. And now we're not talking about student loans for like 20 grand, 30 grand. We're talking hundreds of thousands of dollars of student loan debt. So let's kind of go through this.
It's easy, right? So, I mean, I just ran an application 5 months ago. In this case, it wasn't a Gen Z. It wasn't a millennial. Person was much older, but she had $299,000 worth of debt.
What?
Yes.
Was that the one that was
on her person or on behalf of a child?
Her sons?
No, on her. No children, which is crazy.
She's like an anesthesiologist, right? She's like a doctor.
And I'll tell you this. No, it's in the education industry. She was only making around $87,000 a year income. So it just didn't match to me, right? I think a lot of times because you get these student loans, sometimes there's money that they get, and it just feels like, well, maybe I don't have to go to work and I'll just stick to,
loans.
Getting loans. So it's pretty crazy. So seeing these things.
That is nuts.
I had another one where we're about the same age and they're still paying student loans.
So here was my argument with this. If you're now reducing the payment that was already reduced, oh, great. You're for sure never going to pay them off now.
That's it.
Oh, awesome.
Well, yeah, there's that part. But again, that problem kind of exists on the other side of the fence for us.
Yeah. No, of course.
The argument is it's going to alleviate their debt-to-income ratio and help them be able to afford more. But I know that's the expense of something else. There's a functional question I have for you guys, though.
Yeah.
We have a rule that you have to hit the borrower with a certain percentage of the payment or certain percentage of the loan balance as their monthly, as if it were their monthly payment.
Correct.
Now, I know that's an underwriting rule. Is that at the Fannie and Freddie level, or is that at the bank
VA,
level?
FHA, it's a Fannie and Freddie. It's actually a guideline. Yes.
Okay, so it's a guideline. So now here's the issue. Okay, I'm glad I wanted to ask it. to clarify, because here's going to be the problem. You have to have Fannie Mae, Freddie Mac, Ginnie, and all these agencies go along and be forced by the hand of the rule of law to do this and make it what the actual payment is going to be versus the proposed hypothetical payment while under home ownership.
Yeah.
And that's where the threat comes to the bank and to Fannie and all this, is because this person, even if you don't hit them with their full payment now and their payment, let's say it's even deferred, it's going to come out of deferment at some point while they're an owner and while they have a mortgage, which means that has to be considered in qualification.
Correct.
Well, one of the things I saw right here is that even if, like, let's say they cut down that, that payment, on average, it's only going to help you by 1.5 to 3.6% on your debt to income ratio. And I mean, how?
Well, that's good if you're already on the on that ledge of that. But
what if you're still nowhere there? Like, oh, great! Like now I have like what, 20K, 100K more that 10K more that I can purchase. So I still think that maybe not for everybody this is going to be a solution, because I also think the people that get hit the hardest the most is if when you have 100K, 200K, 300K, student debt, then now you're paying hundreds of dollars a month in your quote unquote monthly payment for your student debt. So even if you take that away, sometimes it doesn't even matter. You need income. That's at the bottom. At the end of the day, you need more income if you want to be able to afford more.
That's it.
Yeah, you can do a debt offset, but if your income doesn't change as well, the debt offset may or may not help you. It may only help you that 1.3 or whatever percent, 1.5 to 3.6%. But here's the thing: chime in if this is you. Like if you are watching this and you see this segment or you see this short, is this you where this plan of a reduced student loan payment actually helped you qualify for a home? I want to know.
Yeah, I like to know.
Here's why. Not because I want to be right on the other side of the argument. I want to celebrate. If this actually helps people, that's fantastic. Let's tell more people about it.
I do like about the article, it's going to get people to start thinking like, well, hey, there's a new program that's out. I have a student loan. I didn't think I qualify with it. So it's going to raise a question, right? Let me see about that. So that's a good thing too.
So here's something I thought of. Remember how we talked about insurance and how carriers are leaving California, and we got these big name insurance carriers that are either leaving or if they're renewing, the premiums are through the roof. You guys are writing premium estimates for like 80, 90, $100 a month. Now it's like $300, $350 a month for premiums. Yeah. This example in this chart says someone who earned $90,000 a year could see their monthly payment shrink from $568 to $238. Okay, that
helps.
It's $350 about, right?
Yeah.
Okay. How much did I just say insurance was a month?
$350.
About $350.
There goes your $350.
That could be making up the difference of the insurance premium cost because of the higher premium amount. So this might actually save someone in that sense. Again, step number one is they want to try to see if this will actually help people qualify based on the actual ratio itself. But even if you are currently qualifying and that premium kicks you in the butt, well, maybe that's your premium right there.
That's it.
It could be. But again, this is a $90,000 example. And this chart has like estimates in the proposal. So yeah.
I mean, we're not telling you not to go to school.
No. I'm not saying that at all.
Go. You got debt. You got this. I mean, the good thing is there's some solutions here.
I don't think these two sides are as close as the article wants them to be. Let me be
that's
completely
what I wanted
candid. I don't think they're like
absolutely
this close. They're like. Can you pull my arm over that way?
I feel it was like quick, throw something on the wall. Oh, yeah, this looks good. Let's see how that goes.
Yeah, I know it's probably easy for us to like armchair quarterback CNBC.
The headline was kind of like, oh, whoa. I kind of read it. I was like, okay. And then I read it. I'm like,
Well, look, here's the deal, and you guys know this, and I hope everyone watching this knows this, is that the monthly payments are competing for that dollar every single month.
Yeah.
We're proposing a mortgage payment that includes taxes and insurance and HOA if there's an HOA, and so we're proposing that and trying to get you approved for a home, while at the same time we're competing, your money is being competed for by your car payment, your credit card payments, any store credit cards you have, your student loan that you have to pay every single month. So, there's a massive competition for your money that's running up against your aspiration to be in home ownership, and maybe this will help some people, maybe it won't. But in the end, it's going to be the math and the willingness of the person.
That's it.
Yeah.
It's all in the math.
Yeah. So paying down other debt will also help you. Whether that means transferring, high interest rate credit cards, 0% interest rate credit cards for 12 or 16 months or 18 months, whatever. Taking advantage of this plan if that qualifies for your federal loan.
That's right.
Maybe that would help you. I know nothing about this actual loan program other than it does relate to housing and real estate, and I'm really curious to see who this will help.
Yeah.
Any other thoughts about this one? I have zero loan debt. Do you have any loan debt?
No, I don't.
You have any loan debt? No.
I'm just glad
I dropped out.
The good thing is, again, I'm glad with the report because it's like...
That was too expensive for me, sorry. They didn't approve me for loans.
Yeah, This
Sorry
is just
to
going to
cut you
get
off.
people that do have the student loans to just go out there and ask questions. So that's a good thing about this.
Yeah. Yeah, if you do have questions, of course, reach out to your local marketplace expert. If you're here in San Diego, of course, you can reach out to us. But if you're not in San Diego, you're watching this out of state or somewhere else, you can find someone in your region that can talk to you about this specifically to your case. In your instance, this is debt-to-income ratio at the personal level.
Yeah.
So when it comes down to qualifying, I think step number one is, are you part of this program? And is your student loan part of this program? And then does this program help you in qualifying, yes or no? All the other things that we typically talk about, like getting your credit in line, paying down your debt, making sure you make all your payments on time, saving money, all those things still apply. You still need to do all those things in order to be qualified to buy a house. So our core set of advice pieces to people in order to get ready to buy a home still exist. This just might be a little bit of a steroid shot for some of you who are being handcuffed and held down by super high loan payments.
That's it.
Memo, what was your favorite part of today's show?
My favorite part actually was the knowing that people are staying in their homes a lot longer than anticipated. I didn't think it was 12 years, but I thought I was actually going to be a little shorter than that. I was surprised with the amount of years, but I can actually consider the fact.
And it was short it was 6.5 years for a long time, and now it's flipped all the way up to 12. That's amazing.
So I'm glad that people that just shows stability, right? And one thing we know, if you have a family, you want stability.
Yeah.
And being in your own home, the kids creating their memories there, that's what I like about all this, is just knowing that the data is there and it's actually working out. So yeah, being stable.
How about you, Brian? What's the favorite part of your show today?
I'm going to take a negative and turn it into a positive. I like how they said uncertainty for 2024 is the only thing that's certain. I think it's a great opportunity that if last year we went through that, we know exactly, what we did wrong. We took lessons from that. Don't take anything for granted this year and just push forward. And nothing's promised. So at least you know that going into it, you have a great chance to go do whatever you want. Just prepare yourself.
Yeah.
My favorite part of the show today, guys, was your new nickname, Median Memo. That's going to be your new name for the month of February.
Median.
And maybe even into March. We'll see what other kind of median data we bring to the show. But until then, you're going to be Median Memo in my books.
All right.
I love you guys.
Let's
Thank you
go.
so much for another great show. And thank you all for watching the Mortgage Heroes Weekly Podcast. If you have not yet subscribed to the channel, hit that subscribe button. Make sure you turn on notifications so you catch every episode. Like this video and send it on to someone who you know, love, and trust. And while you're at it, go check out some shorts down the YouTube feed. Engage, comment, share those as well. We're trying to bring more high-value content throughout 2024, and we also have a new show called Friends of Mortgage Heroes, where Brian, William, and myself interview our friends in and around real estate in a variety of industries to help not only raise our education, give back to the community, and help more people be more knowledgeable, aware, and effective in their real estate ownership and their execution of investing.
That's it. We want to give back to the community. We value them so much. They do so much for us that we feel like the least thing we can do is, be of service to you guys and bring these great people around that we surround ourselves with and just bring them to you.
Yep. So our friends are now your friends too.
That's
and
it.
make sure you go check out the Friends of Mortgage Heroes playlist on YouTube and jump in there and watch a couple of those episodes and let us know what you think. We have some amazing shows already pre-recorded that are releasing for the rest of February and in March. You guys are going to love the guests and their knowledge and their experience and the wisdom that they share. I'm really excited. I'm sorry I'm dragging this out. I love what you guys are doing on Friends of Mortgage Heroes, and I think it's going to be a great attachment to what we're doing here on the more nerdy side. Thank you for playing along. But I think this is going to actually help our audience broadly, way, in addition, way more than what we're just talking about here, like article-wise.
I agree.
100%.
Yeah. All right. Well, thank you guys for a great show, and we'll see you all next week.
Yep.
Bye, guys.
See ya.